Today what we're going to do is take a look at some actual transactions that a company might go through and how we could record them. Not the way that they're actually recorded in a normal accounting system, but just sort of back of the envelope or in a very simplistic way, how we could keep track of it and get a sense of what's going on vis-a-vis actual transactions and the accounting equation. So here's a few very simple transactions that a company might go through. What we're doing here is we're setting up a brand new consulting company. And the first transaction is the owner's invested $5,000 of cash into his company. So he's taken $5,000 of his own money out of his bank account, put it into the company's bank account. The second one is he's gone and he's purchased a new computer for the business, and he paid $2,000 cash for the computer. In the third one, he's rented some office space and he paid rent, also $2,000. Rent is always paid in cash, we assume, so I didn't bother writing in cash. In the fourth one, he's completed a job for somebody. So he's gone and done some consulting work for somebody. He's completed the work and he sent them an invoice saying that they owe him $3,000. He hasn't received the money yet, but remember what we said previously, that would be an account receivable. And then in the last one, he's withdrawn $500 of cash to go and buy whatever he wants for himself personally. So those are our transactions. Let's take a look at how they might get recorded very simply just by looking at assets and liabilities. In the first one, we said he's going to invest $5,000 of cash. So that means that the company is going to have $5,000 of cash, and that investment is going to get recorded as capital in the business or as equity. So our capital is going to increase by $5,000. And cash being an asset, we can just very quickly go up here and say plus 5,000. Capital is equity, so we'll put plus 5,000 here. And you can see we have 5,000 on this side of the equation, 5,000 on this side of the equation. It's in balance, so that one's okay. Next, he purchases a computer. So the computer we're going to call equipment. We'll put that in our equipment account over here. And then we're going to increase that by $2,000 for the purchase of a computer. And because he paid cash, his cash balance is going to go down, and I'm actually going to put that in brackets. In accounting, we tend to use brackets to denote a negative number just because it's very easy to miss out on little minus signs, whereas brackets you never miss out on, so there's no confusion. So our cash has gone down by 2,000, equipment's gone up. Cash is an asset, so minus 2,000. And the computer is equipment, so it will have increased by 2,000. We'll put in plus 2,000. And we have a minus 2,000 and a plus 2,000 on the same side of the equation. It's in balance. Keep going. He pays rent. Rent is an expense. It's a cost that he has to incur in order to run the business. So his rent expense is going to increase. We're going to keep track of that over here. And he paid cash again, so again, minus $2,000 of cash. So if we go up here, minus 2,000 in the assets. And if you recall, we said that expenses are a form of equity. They're actually negative equity. They reduce equity. And so the rent expense is going to reduce equity by $2,000. Minus 2,000, minus 2,000, we're in balance. Next, he completes a job. So that's going to be revenue. Well, he's going to have revenue of $3,000 for completing the job. And we can put that right up here. Revenue is equity, so $3,000. And he didn't receive the cash yet, but instead he received an account receivable, or he sets up an account receivable, meaning that he's owed $3,000. So we'll put that under accounts receivable. And that's an asset. Claims that the company has are assets. Plus 3,000, plus 3,000. Finally, he withdraws $500. So we're going to keep track of that in our withdrawal account. $500. And that's cash that was taken out of the business. So we'll reduce cash by $500. And finally, we'll just go up here and we'll put in, we've reduced cash by 500. A withdrawal, we said, is negative equity again. It's a reduction in the company's equity. Minus 500. And once again, we're in balance. Now, that actually works. And you can see that we can add this up and figure out that he's got $500 left of cash from the original $5,000. He's got $5,000 of capital, some AR, some equipment, so on and so forth. And we've checked each of these against the accounting equation to make sure that everything stays in balance. So this system of keeping track of our accounts could work, but imagine if you were a massive company. Imagine if you were General Motors or Apple and you had to keep track of every single transaction this way. It would be nearly impossible to keep track of what was going on, and also nearly impossible to make sure that you didn't at some point go out of balance. So it's not a very effective way of working on sort of a macro scale. And so what we're going to do now is we're going to start to look at how we actually use the accounting system along with the accounting equation to come up with a simplified way of keeping track of what's in all of the accounts, and also making sure that our accounting equation always remains in balance and that we're recording things properly. So stay tuned for that in an upcoming video.